You know when you drive past a massive construction site, see a skyscraper going up or a huge wind farm on the horizon, and you just think, how on earth does something that big actually get paid for? Well, today, we're going to connect those dots, from the nuts and bolts of a single bulldozer all the way up to the crazy complex balance sheets that literally build our world. Let's get into it. So, you see these incredible machines, right? Like this Caterpillar D8R, just shaping the entire landscape. They're these amazing symbols of power and progress. But the real story, the one we're talking about today, isn't just about moving dirt. Behind every single piece of that steel is this just dizzying world of finance, of risk, and of billion-dollar decisions. So how does it all actually work?
It all starts at the most fundamental level. I mean, before you can even think about financing a project that needs 100 of these things, you have to know the value of just one. So what's a bulldozer really worth?
And trust me, that is not a simple question. We're talking about a piece of equipment with thousands of moving parts, working in the harshest conditions you can imagine, with technology that's constantly changing. How in the world do you put one single, accurate number on its value?
Well, one thing's for sure. It's not the price it had in the showroom. An asset's value is a moving target. It is constantly being pulled down by a financial force that's as real as gravity. And that process, it's called depreciation.
And the official definition is actually pretty simple. Depreciation is just a loss in value from, get this, all causes. That's it. It's the universal financial truth for pretty much any physical asset. Everything from your car to a massive crane loses value over time. The real question is why and how. Okay, so to figure that out, professional appraisers don't just, guess. They have a formal toolkit with 3 totally distinct methods they use to pinpoint an asset's worth. Let's take a quick look at how they do it. So first up, they use the market approach. It's kind of like real estate, right? They just look at what similar pieces of equipment have sold for recently. Easy enough. Second is the cost approach. Here, they calculate what it would cost to build a brand new substitute from scratch, and then they subtract value for age and wear. And finally, you have the income approach, which asks the most important question of all: how much money will this machine actually make over the rest of its useful life? But here's the thing, no matter which method you use, the result is always affected by that downward pull of depreciation. There are 3 main culprits that are constantly chipping away at an asset's value. Let's break them down real quick.
First up is the one we all get, physical deterioration. This is the obvious stuff. Rust, engine wear, metal fatigue. It's the simple, unavoidable consequence of using a machine to do really hard work. It's the wear and tear you can literally see and feel.
Next, there's functional obsolescence. Now, this one's a little more subtle. Your machine might be in perfect working condition, but it loses value simply because a newer, better, more efficient model just came out. Think of an old flip phone versus the latest smartphone. The old one still makes calls, sure, but its value has totally tanked because technology just moved on. And finally, there's the one you have absolutely no control over: economic obsolescence. This is when forces completely outside the project hammer the value of your asset. A change in environmental laws, a recession in the construction industry, or a flood of cheaper competition. All of this can make your perfectly good equipment worth a whole lot less, almost overnight. Okay, so now we get how a single asset is valued. But, massive projects aren't built with just one bulldozer. They're built with fleets of equipment and mountains of cash. So, let's zoom out to the big picture. How do you finance the entire thing? Knowing what your assets are worth is absolutely crucial, but it's just one tiny piece of this giant puzzle. How do you actually leverage that knowledge to get the funding for a project that costs hundreds of millions or even billions of dollars?
Well, you do it with a very special tool called project finance. What's so interesting here is that unlike a regular loan, lenders are not primarily looking at the borrower's bank account. No, they are betting on the future success of the project itself. The loan gets paid back from the money the project is going to generate. All those bulldozers and cranes, they're just the backup plan, the collateral.
And this table really shows you the key differences. With normal corporate financing, if you default on a loan, the bank can come after all your company's assets, your headquarters, your other successful projects, everything. But with project financing, the lenders are walled off. Their only guarantee is the project itself. And that's exactly why they are so obsessed with future cash flow. It's a total high-wire act, where the entire loan is balanced on the projected success of just one single venture.
And because that risk is so focused, lenders are incredibly careful. They won't even look at a project unless it's what they call shovel-ready. That means a super detailed feasibility study is done, all the government permits are in hand, the first round of investor money is committed, and major contracts are already in place. They need to know the project is real before they'll bet the farm on it.
So, you've got your valuation methods, you've got your financing structure, everything seems good to go. But then, the real world intervenes. Let's look at how external forces, like new regulations, can just throw a giant wrench in the works.
So here is a perfect example of that economic obsolescence we talked about happening in real time. This Kenworth truck, it has a Tier 3 engine. For years, it was an absolute workhorse. But in 2019, Canada began phasing out new imports of Tier 3 equipment for cleaner Tier 4 standards. All of a sudden, this perfectly functional truck became part of a dying breed. And here's the rub. The new Tier 4 engines are, no question, better for the environment. But, as this quote makes crystal clear, they come with a hefty price tag. They cost more to buy, and they cost more to maintain. So the bottom line is, a rule change designed to help the planet directly increases the cost and the complexity of building the project.
Now, this second major hurdle is something every single project fears: delays. In the world of project finance, time isn't just money, it's a potential catastrophe. A delay can completely unravel the delicate financial structure holding the whole thing together.
See, a delay creates this unbelievably dangerous domino effect. That great low interest rate you locked in, whoops, it expired. Now you're at the mercy of the market. The lender hits you with extension fees. All the while, you're still paying for the land and the equipment every single day the project isn't making money. Worst case scenario, the bank might make you get a whole new appraisal and re-qualify for the loan right in the middle of construction. It is a true financial nightmare.
So when you put it all together, from valuing a single machine to the complexities of global finance and all these real-world problems, you start to see what building something big is really all about.
It is a high-stakes balancing act. Every single major project is a calculated risk, carefully weighing the tangible value of its assets against a financing structure that's built entirely on promises about the future, all while trying to navigate a minefield of regulations, delays, and costs nobody saw coming.
From the bulldozer all the way to the balance sheet, it is an incredibly complex and risky business. Which really makes you wonder, knowing just how hard it is and how much can possibly go wrong, what monumental project will we have the courage to build next?